Good morning and welcome back to Almus Market Mornings. The conflict in the Middle East is the square focus of the markets. The Strait of Hormuz, through which 20% of the world's oil supply flows through, seems to be impaired. President Trump has been talking about a potential US naval convoy for ships passing through, but the general concern remains on the energy security. Large oil and energy LNG refining plants are closed in the Middle East due to the Iranian strikes, and they are adding to the higher cost of oil and LNG. Uh, of course, this impact if not transitory, would bring in a wave of inflation. But at this point, the discussion may be around supplies. Import-dependent countries, including India, Korea, are seeing their currency weaken significantly against the dollar. But moreover, dollar has gained significantly overall in the last few days as well. Uh, Good morning, JK. A lot of whipsaw movement in the markets. What are your thoughts on these recent moves?
Good morning, Swaraj. It's not at all surprising because we have had kind of a market in a state of equilibrium for quite some time now. And while the US-Iran standoff had been around for some time, the suddenness of the war has caught everyone by surprise, and also the severity of attack as well as the retaliatory action by Iran have put in a lot more uncertainty to the whole issue. Like you talked about the Strait of Hormuz being closed and then possibly closed and then affecting the crude oil supplies. Now, uh, actually, Iran has not closed. Iranian forces or authorities have not closed it, but the shipping companies themselves are now hesitating to carry the cargo through that in view of the high risks involved, and that is where the President Trump's executive order came in overnight, saying that the U.S. Finance Department will provide political risk coverage for all the shipments through the strait, particularly the energy carriers. But how far this assurance will be relied upon and the ships are allowed to carry on is something that we need to wait and see, of course. And as you said, the closure of some of the oil refining facilities and as well as the LNG facility in Qatar is again a big setback for the oil market. So supply chain issue is the most severe challenge for the major economies like India, China, Japan, Korea, and then of course comes the pricing part. So these are not going to be resolved, in a hurry, because it does look, as we enter the fifth day of the conflict, it does look as if it will carry on for much longer. In fact, we have had the news that the new Iranian leader has been chosen in place of Mr. The Khamenei, who has died in the recent conflict. But the reports also indicate that the new leader is who is the second eldest son of Khamenei, is also a hardliner, and he has got a huge support for the IRGC, which is the militant arm of the Iranian authorities. So I think we are not going to see any peace process emerge anytime soon, and I think we have to live with these tensions for some more time. That is what the markets are actually reflecting. If you look at, for example, the Korean market, South Korean market, it has fallen almost 16% in the last two trading days. Japan almost 8%. And, US markets have been somewhat better off only for the reason that US is well secured with their own energy resources. That's the only point. Otherwise, even the US markets have been negative. Europe is the other market which is severely affected because of almost 70% rise in the natural gas prices. So is the case with UK. So I think these are very severe conditions that have emerged in a very short period of time. It takes economies to cope up with these. Like, for example, India has got an assurance from Russia that they will fulfill the shortages in the energy supplies created due to the war. However, again, the Russian oil is not going to be available to us at same cheap rates as before. We don't know whether the discounts will be offered, and at the same time, India will also be thinking twice before this arrangement, because we are always under the radar of US. If you resume importing from Russia, whether they will take any fresh trade action or tariff, that is something that we need to consider very seriously before we do that. So I think we are going to see continuation of the stock markets under stress, and the currencies. Obviously, dollar is ruling high against almost all the currencies. Now, adding to all this is the emergence of a bond market sell-off, and bond market is selling off because of expected inflation being higher in almost all the countries. Main contributor, of course, being the crude oil. Apart from that, we also got the Eurozone inflation data that came on on Monday, that showed the inflation increasing from 1.7 to 1.9%. The negative contribution from energy prices was there in February, but definitely that is going to rise in the coming month. The increase was seen for services side inflation in a big way. And similarly was the case with ISM manufacturing in the US. There also the index was slightly higher, slightly lower than what it was in January, but the price pressures were seen very severe. So the price index was driven by increases in many commodities as well in the manufacturing sector. So while we are seeing activities in the manufacturing sector, etc., quite held up, but the price pressures are again on the radar now. Just to give you an example, US 10-year yield, which was trading at 3.96 2 days before, as safe haven buying of treasuries was in full force. We have seen the yield go up to 4.12% in no time. And then, of course, the UK Treasury yields are also now up more than 30 basis points. German yields are up by 15 basis points. So this trend is probably going to continue at least till we have the war-related supply chain issues and oil price rises. You know kept up. If you look at the oil price chart itself, we are already in the 80s, and either the continuation of the conflict or any more severe actions from either side could easily lead it towards 92, and that is not good for particularly the energy importing countries like India. So on the currencies, as I said, dollar has risen almost against all currencies, even the euro, which is quite a stable currency, which is also acted as safe haven for quite some time, now collapsed because of the energy prices going up on the natural gases, 70% rise. So and also the fact that the Eurozone inflation has come higher has actually suddenly given rise to talk about the next move by Europe, being a rate hike coming as early as this year. So that is also given rise to Eurozone stocks falling quite a bit, and euro losing the support at 1.17 and trading as low as 1.1530. UK pound, apart from the energy issues, is also hit by the political problems. Japanese yen, again, a large importer of oil. And, what is notable is that while Japanese yen was weakening along with the rise in the EM assets like South Korea, South Africa, and some of the Latin American countries, that was carry trade, due to which yen was weakening. But now even as those markets are falling and those currencies are falling, Japanese yen has not really strengthened, which normally would have been expected due to unwind of carry trades. So I think market is really testing the yen's limit on the downside. 158 has not been traded so far, but there are already verbal statements from Japanese authorities about having to act on the currency, and they even said that they have an understanding with the US. So that is something to be taken note of. Last time at these levels, there was a rate check by US as well as Japan, and we saw the trade Japanese yen trade as high as 152 against the USD. That is something that we are looking at. Gold had to, obviously as a safe haven, go up almost touching 5.4 or even 5.5 level was almost nearby. But then, as both stocks and bonds have fallen, the liquidity requirement by investors and traders has led to unloading of long position in gold to book some profits and provide the get the liquidity. That has seen the gold slip to 5050 levels, but then I think the 5,000 level has been quite steadily holding. That remains probably a good support unless we see another big bout of sell-off in the asset markets all across. Then we could see, gold falling. Silver has held the 80 levels quite well. Again, you know, what is also emerging from all this is that the defense industry is going to gain a lot. Every country will be looking to shore up their defense capabilities, and that will have its own demand on some of the base metals and silver, etc. So we are in a very confusing state where it will be good for the market, where it is not good for the market. But overall, I think it's going to be some stress for some more time. Rupee already hit a new low against the dollar at 92.23. A very swift move after breaking 91, and that's normally the case. But this time around, at least what we are seeing is that the rupee has fallen along with other currencies. So the authorities may not be so much worried, and it's also driven by good economic reasons, like higher oil prices. And if it continues, maybe even the growth will be hit. So these are the points which will keep the rupee on the weaker side for some more time. If stress continues, a move towards 93 is likely. But if there are unreasonable moves, or market becomes too volatile, there will be some intervention. But such intervention, if it brings the rate down, we will see important interest emerge once again. Thank you.
Thank you, Jack. And yeah, we are tracking the broad dollar strength, mainly due to this conflict. We are seeing stocks, bonds get sold off. Even precious metal long positions were unwound. Gold, silver slipped significantly on these particular updates. Mainly, the fear is because of the higher energy prices, inflation will tick up. And the precursor to all of this is that before this war, there was already fears of inflation ticking up. So this just added to that pressure and led to a significant sell-off in bonds. So these are the few narratives we'll be tracking quite closely. It's the fifth day of conflict. As of now, looks like it will carry on for some time. We'll see how all of this plays out. That's it from us today. Thanks for listening. We will catch up tomorrow with the fresh round of updates.